is now 498 is the new 2024 loan limit. And so we are live on all these loan limits because what our lender will do, like UWM, they will basically hold on to the note and then sell the loan come January. So even if we fund a loan, let's say today, we could do that at the new loan limit. So anybody who has a loan in process where it's 755,000, if they're short, like they should probably reevaluate that loan because they might be able to get a much lower rate now that it's conforming as opposed to like high balance or jumbo. So that is live. And then want to also highlight the multifamily 5% down new loan to value ratio. So previously, when under Fannie Mae, if you're going to buy a 4-unit property, you'd have to put a 25% down payment, even if you're occupying one of the units. That that down payment is now 5% down. So this is up to the nationwide conforming loan limit, not the high balance area. So this is like 1,447,000. So you can buy a 4-unit property with 5% down, get a low rate. PMI will be low if they have excellent credit. If not, you can go FHA. But ideally, if they're buying a 4-unit property, they should have excellent credit. So just want to highlight this because I actually already have a loan in the pipeline. This was announced on November 18th, and already someone's in contract under this new program. And the realtor that I've worked with, they really feel like this fits the persona of a millennial or Gen Z buyer. So there's like a house hacking element to it. Like, so if you have a buyer who's maybe not ready for a single family home, like for a family home, but wants to basically get their get started on it on like a fantastic real estate investment. I think this is a great product for them because 25% down is a really tough hurdle to hit on a 4-unit, but 5% down. So if you're buying let's say $5 million 4-unit property, 5% down is what's that? That's like $75K. So this fits kind of like higher income, but not rich yet. And again, kind of a younger demographic. So just wanted to share because getting traction on that. And then we did a webinar or room on temporary buy down, but this continues to be our most used product with UWM on purchase transactions. So you can basically take, let's say, a 7.5% rate, and then we can have the rate for the first year be 6.5, and this can be funded actually by the lender credit. Since we kind of operate on discounted broker compensation, we can get the lender credit to pick up the tab. All right, so that's just the market updates that I have, and then let's get rolling. So every day I will write a little blurb about where we are at rates wise, and then like some market commentary. I think you get the emails that are sent by LoanDesk. So this is kind of where it comes from. And basically I just run a scenario based on a $500,000 purchase price with $100,000 down, assuming good credit. So it's kind of just like the basic scenario. And so you can see here, rates, basically this was on 8/1, 7.125, and this is all kind of that basic scenario. You see how like rates have changed: 7.75, 10/19, 7.875. We're like, uh-oh. And then look like what's been happening basically since October 25th. Staying at that, and then we got a big, see, I even mentioned big rally in the bond market due to non-farm payroll and unemployment reporting. So it came in lower than expected, and then that caused bond prices to go down. So you can see kind of rates really starting to go down. And then this was again a big jump from 13 to 14. CPA came in below expectations, showing inflation's slowing. And then ever since basically 2014, it's kind of hovered around there. And then Today's actually the lowest 12.5 since we started even keeping track of this. So she's on the radio. I don't think we sent an email today because we send out the emails on Monday and Thursday, but we do the postings on our social and Radius community. So 6.625, and again, it's just showing that there's more and more data showing inflation is cooling, and that so in this case, like the factory orders came in showing a decrease, in which is less than the 3% drop that was expected. So that leads me to mortgage refinances. So somebody who got just last month a 7.875, they could potentially refinance their mortgage to 6.65. Like, that's how quick it can go. So you got to be ready, on these refis, if you plan on basically originating them, but also as a real estate agent, I really feel like sometimes refis are in some ways a way for you to continue to stay in contact with your client, because one of the questions I ask when I have any inquiry for a refinance, say, okay, well, how long do you plan on owning the home? And that's obviously very pertinent information for you as a real estate agent. So let's run some numbers here. And how they answer that question, it really will dictate kind of the option. So like if they say, oh, this is my forever home, I'm never selling, then hey, maybe it's an opportunity to get into a low rate, and it's kind of a set it and forget it rate. But if they say, maybe 2-3 years, well, even in those 36 months, let's say it's 3 years, they can still benefit from a refinance. And so I always look at refinancing as whenever you can lower your interest rate and get a lender credit to cover the closing cost, then it's never a bad idea to do it. So I'll repeat that. In my opinion, if you can lower your interest rate and get a lender credit to cover the closing costs, the fees are $0, then it's never a bad idea to do the refinance. So that's kind of my thought process. Now people say, oh, what about restarting the clock on a 30-year fix? Well, I have two responses. One is you don't have to. We actually work with lenders that will allow you to set kind of odd terms. So like a 27-year term or a 28-year term if they've made 2 years of payments. We have even lenders that will do it down to the month. Like if you want to do 28.4 years, they will accept that. Or if you go back to a new 30-year fix, you could just pay extra towards the mortgage payment because there's no prepayment penalties. So you could even just keep making your same payment as what you were paying before, and now you're paying off the loan faster than the amortization schedule you were on before the refinance, because now your interest rate is lower. So let's run a scenario with UWM, and just so we can see what let's just go through a loan. We'll say test. Okay, and we're going to say it's a $400,000 loan amount, and it's a $500,000 property, and it's a refinance, just basic. Say it's California. Okay. Okay, so the computer's a little slow right now. We'll say I have excellent credit, which everyone should strive for. And for now, we're just going to do this at borrower paid. So meaning like we're going to show the wholesale rates without any broker compensation paid in. By the way, if anyone has questions, feel free to chime in while UWM's site is loading. All right. And then, so we want to just, so we have to wait for this to load. 30-year fix, we'll say. And again, we can set the term to a unique term. We could do 28 years. We could do 29 years. Okay. Getting an error here with UWM. I don't know if it's because I'm sharing screen. Let me try. Well, let's go to Rocket.
Sorry, just give it a sec. It usually always takes a little bit to load, but it'll
I'm not sure if it's rooms or if it's UWM. So let's try a different scenario.
Try loading it separately when your screen isn't shared, and then if it loads, then you can share your screen again once the
All right. Well, we'll try with Rocket. This is the benefit of being a broker. You have lots of options. All right. So we'll do 780 credit score. And for now, like, we don't even really care about the income. We just want to see rates. And say San Francisco, do rate and term, conventional. Okay. And we're going to just make the compensation borrow pay because we're going to basically check the wholesale rates. This is kind of our superpower as a broker is we can pass wholesale rates to consumers with very low markup or no markup. So we don't need to say this. So this is a rate and term, just a standard rate and term. And I want to go over kind of what I was talking about with getting a lender credit. So because this is what people don't really understand that I think a lot of consumers don't understand. So first, so you can see here, if you want to do a 29-year loan, 28-year loan, 27-year loan, that's all possible. So let's just look at the 30-year loan. And this is often that 28, 29 year is like a big barrier, or like it's actually a great way to explain to someone like the benefit of refinancing, because going back to a new 30-year fix is usually the number one complaint. Okay, so we know how I showed you on the rate that like the average rates were like at 7.75, 7.65 just 2 months ago. So let's say someone took a 7.625. So at today's rates, let's say they took a 6.75% rate. They're getting a $3,700 lender credit. So the way that mortgage rates work is the lower the rate, the higher the cost. The higher the rate, the less the cost. So someone could take, a 5.99, but then let's look at the fees. Like, it's going to be really expensive. Now you're paying $9,193 in fees, and that doesn't even include, property taxes and homeowners insurance, assuming they wanted to set that up. So it may not make the most sense, even though the payment is lower. What I like to recommend is, like, as a homeowner, your benefit is you can refinance whenever you can get a lender credit to cover the cost. If it happens again 2 years from now, you could do it again. There's no limitation to your benefit to refinance. So that's why I like this 6.75. Normally fees are around $3,500. Let's see if I'm right about that. Yep. So in this case, we're getting a lender credit here of $3,660. And so then that covers all the fees. So the fees are around $3,200. And so in this case, the total fees are negative. So this is what's called a negative closing cost refinance. This is what I tried to pioneer at my previous company. It's the idea of negative closing cost refinances, where you get the lender to pay you to refinance as the borrower. You don't pay to refinance, the lender pays you. And the way that works is you just choose a rate where the lender credit goes is exceeds the fees on the loan. So like even that 7.5 borrower, like let's say they 7.5, they could even take, let's say, a 699. They're still dropping their rate by 0.5%. But now let's look at the fees on this one. The fees are negative $3,600. So people have no idea that this exists. You can get paid $3,600 to refinance your mortgage into a lower rate. And I have heard this so many times, like, what's the catch? Well, why would the lender do this? Well, the reality is the lender's taking the loan, then they're selling it to Fannie Mae. See, the market has changed. The bond yields have changed. Now, bond yields were approaching 5% just 2 months ago on the 10-year Treasury. Now, hey, they're coming down to 4%. So there's nothing really changed. The lender's still earning their money. They're still earning their basis points. Now, this is a wholesale rate, so the lender operates on a very thin margin. But it's essentially you can get paid to refinance your mortgage. Now, how can you use this negative $3,600? Well, it could be applied in two ways. One, it could go towards property taxes. So let's say you want to set up your escrow account. Well, what you'll do is you'll set up your new escrow account. Taxes are coming due, and you'll put this $3,600 towards property taxes, and then your existing escrow account with your previous lender is then refunded to you. So that's how you can take advantage of this. Now, let's say you don't want to have an escrow account. Well, if that's the case, then you can have this go towards prepaid interest, or it could even be applied as unpaid principal reduction. So let's say if it's a $400,000 loan and you're getting a $3,000 negative closing cost, then your starting balance on your first mortgage statement will be $397,000. You were just paid $3,000 to refinance. It's amazing that homeowners are unaware of this benefit to them as a homeowner, because to me, this is the biggest advantage of being a homeowner, is that you have a one-way negotiation, whereas as a tenant, you really don't. Like basically, the rent's going to probably go up. So this is what I wanted to share. I'm going to just pause here and see if there's any questions.
Anyone have any questions or no? I guess not. You guys just understand everything.
Everyone's just dazzled by Joseph's presentation.
That's what it is, bro.
Exactly.
Jaws are on the floor. What? I can get paid to refinance your mortgage? Yeah, you can. Oh, let me add something here, because there's how I mentioned that temporary buy down program. So there's some confusion about this. So lenders are kind of using this temporary buy down to prevent people from refinancing the mortgage. That's why this program is so popular. Because let's say if it's a 1 year temporary buy down, you do a 7.5 rate, 6.5 is your first year payment. So the goal is like, okay, so they're not going to refinance for the first year because they have that 6.5. But the reality, the way that temporary buy down works is you set aside the interest differential into an escrow account, similar to an escrow account for your property taxes and insurance. And so that borrower is at a 7.5 rate. And if they want to refinance after 8 months, as opposed to 1 year, they are more than welcome to. Like they are not precluded to refinance their mortgage while they're in the temporary buy down period. This is in many ways like a marketing ploy, that because when the lender makes the loan, they really don't want a borrower to refinance their mortgage within 1 year. Otherwise, they have to repay Fannie Mae what they earned on it, their gain in sale. So that's why the temporary buy down is, while it's a great program to help people with affordability, there is kind of a and that's how servicers really suffer. All right. Well, thanks everyone for joining.
Thank you all so much. As per usual, we have our LoanDesk rooms every Tuesday at the same time, 12:30 p.m. Pacific Standard Time. So we'll have new content for you guys each week. And so we'll see you next time. Have a good rest of your Tuesday, everyone. Take care.